Kia ora and welcome to episode 84 of Bridge Talks Business with Milford. It is time for a 6-month outlook. How's your KiwiSaver balance going to look over the next 6 months? How's the global economy going to look over the next 6 months? These are the questions I'm asking Mark Riggall from Milford. He's a man in the know, and when he talks, I tend to listen. First, here's your top 5 business bits. Number 1, the Reserve Bank hiking 25 basis points, saying they'll move us back to their perception of neutral. They said the economy's improved, but inflation remains too high, noting, though, this is more of a removal of stimulus rather than a tightening. Number 2, economic data in New Zealand seem to support some of this view, with the PMI and the PSI both showing improvement. Manufacturing in particular, very strong, with details suggesting a broad improvement and forward-looking indicators getting better as well. Materially, business surveys data incoming will shed more light on that. Number 3, the combination of better data and the RBNZ signalling hikes has helped lift the New Zealand-Aussie cross off the lows. We've also seen short-term interest rates back up toward the one-year highs, helped by renewed conflict in the Middle East. Number 4, the US reinitiated attacks on Iran last week after a lack of progress on the deal front. This has seen oil prices rise up to $83 a barrel, sparking more inflationary concerns globally. Finally, this week we get some key data. US CPI, given hawkish comments from the Fed in recent weeks, watching closely. We also get the start of US company reporting, with the major banks releasing their quarterly results later this week. Right, Mark is here. Let's not waste any more time. Just a reminder, this segment is informational only and should not be considered financial advice. Mark, welcome back to the podcast.
Great to be here.
Great to see you. Always good to check in. We're halfway through the year. Thought we'd get you in and do a little sit rep.
Yep.
So in terms of, let's start with share markets. Let's start in the US. Obviously, things have been going pretty well on the whole. How do you look at it?
Yeah, I mean, it's been actually a reasonable year. We had a speed bump, obviously, with the Iran geopolitical crisis, caused a bit of a weakness in March and April, but, you know, the market took off really at the end of March. And lo, behold, we've actually had a reasonable kind of year-to-date return from the US market. That's not, been all driven by the entire market. It's a pocket of the market, technology, which has been the key driver of returns, but it has lifted the entire US market, given the weight of technology within US shares. Yeah.
You've described it as becoming a market of stocks. What do you mean by that?
Yeah, so normally when we think about share markets, they tend to kind of go up and down, all largely together. So stocks are what we call correlated. So when one stock goes up, other stocks tend to go up as well. What we're seeing at the moment is actually when one stock or group of stocks goes up, another group of stocks goes down. And so the market or the index at a kind of top level doesn't really change, but you're seeing lots of volatility under the surface, right? And so we can think about technology as being one homogenous group, but it's not acting like that. It's acting like lots of different groups. Like you've got the Mag 7, like the Microsofts and the Metas and the Googles. And then you've got semiconductor companies, right, which are a separate group, NVIDIA's and you have Taiwan Semiconductors. And then you've got other tech hardware like memory chip makers like Micron or SK Hynix in Korea. And then you've got software names, which are like Microsoft or ServiceNow and people like that. And these are all different groups. And when one of those groups is doing really well on a given day, chances are another of the groups is not doing so well. And you're seeing lots and lots of volatility under the surface. So it's a market of stocks. It's the stocks are really moving around of their own accord because of the idiosyncratic drivers of those stocks. But it means the index is actually quite calm at a top level. So it looks like nothing going on. In fact, the opposite. There's lots going on under the surface.
Underneath, there'll be a bunch of people making a bunch of money or not, depending on which way they...
Honestly, it's a day-by-day thing. It really is. And so we have seen trends. Like there's been, semiconductors have done reasonably well, but memory chip makers have done fantastically well over the past kind of 6 months, and over the last month started to see some volatility there as well.
And what's driving that? Is that because the whole AI revolution thing's happening very quickly right before our eyes, the more we learn about how much we need different parts and components? Is that kind of what drives that on a day-to-day basis?
Yeah, again, let's step back and think about the drivers of share market performance. Well, ultimately, shares are thinking about profitability of companies. So if companies are delivering good profits, then you tend to want to own those shares, right? And what we're seeing is the market as a whole is delivering strong profit growth, right? Year over year of 25% plus, right? And this is in the US. And that really is unusual because what normally happens at the beginning of an economic cycle, when you're coming out of a depression or recession, you see a big acceleration in earnings. This is happening kind of mid to late cycle, right? And it's been driven largely by this technology boom. And so what we're seeing is the hyperscalers, the Metas, the Googles, they're all spending money, CapEx, and they're spending it on semiconductor chips. So the profits of the semiconductor chip companies are going up, but they also need other bits and pieces to deliver this AI, like memory chips, and that's why the profits of the memory chip makers are going up, a lot. So what we're seeing is a profits boom. Valuations of stocks are actually going down because the stock prices are not rallying as much as the profits are going up, which is kind of incredible, but that's the situation we're in. So valuations actually look reasonable, but we're in a profits boom at the moment. And the question is, how long does that profits boom last for?
What about the rest of the world? I mean, you mentioned Hynix, which is a Korean company, which listed on NASDAQ.
Yeah.
Valuation through the roof, but other stocks around the world.
Yeah, so, I mean, Asia, like Korea, Japan, doing very, very well. That's all caught up in the same technology boom that the US has largely got exposure to. So they're kind of linked, if you like. If you think about other regions like Europe, UK, Australia, New Zealand, a lot more muted, right? We don't have as much exposure in those regions to technology. And so you're just looking at kind of your Common or Garden, Steady Eddie type stocks that we used to be interested in before this AI boom came along. And they're doing all right, right? You're talking kind of mid-single digit, high single digit returns over the first 6 months of the year, which is not to be sniffed at all. So it's actually pretty reasonable, but pales in significance compared to some of the returns that you've seen, or highly volatile but strong returns that you've seen from the technology companies.
All right, so here's the big question that I'm wanting to ask you is so first half of the year, yeah, rock and roll, but a lot more rocking than rolling. What about second half?
Yeah, so second half is where, normally we start thinking about top down, what are the big things driving the market, but actually it's the nuts and bolts, it's the nitty gritty, it's the company earnings. So what are companies saying about how they can monetize AI, right? And if the ones doing the spending, like, the hyperscalers, if they're getting good earnings growth and can continue that spending, that sustains the technology boom even longer. If there's evidence that people are using AI more and more, and companies that are supplying the AI, the LLMs, are actually monetizing that, getting revenue from that in an increasing way, then that can sustain this boom further, right? And that's a question we don't know the answer to yet. We try and grapple around and get some data points around that, but over the next 3 to 4 weeks in the US, we get quarterly earnings reports, and that's going to be a key guidepost for how this technology boom is going to kind of keep going or not for the next 6 months.
Where are we at because there's obviously a whole bunch of companies that are listed on the stock exchange who employ a bunch of people, employ a bunch of us. Where are we at with this AI overtaking some of those jobs, that undermining the consumer, that having an effect on economies' bottom lines? Are we anywhere near sort of worrying about that point in time yet?
Yeah, so for a while there was a bit of a panic about we're going to see lots of jobs being lost because AI is going to replace them. I think that panic has subsided somewhat. I think people are now coming around to the fact that AI is supplementing labor, not replacing labor. And so when people are doing things using large language models, they're doing things to help them be more productive in their role. But it's not something that the AI could do of its own accord. You need someone there to drive it and use it. And so that means that you get more productivity, more, people are doing more with the same, amount of labor, which is great for company earnings, but also you don't get that kind of risk of mass redundancies on the other side. Yeah.
Phew. Dodged it for now. All right, so we've done shares. What about bonds?
Yeah, so kind of interesting as well. Not so quite as exciting as shares, but
bonds never seem to be
they
just exciting.
You know, we do have diversified portfolios and funds that do invest in bonds, and so we pay attention to those as well. And what we're seeing is inflation is not going away, unfortunately. So we're now in kind of year 6 of elevated inflation, and central bankers' patience is wearing thin, right? And the latest inflation driver, of course, is oil price. We saw, oil kind of move from kind of 50, 60 to over 100, and now it's back to kind of mid 70s. And so there's been some volatility, but oil prices are being elevated, and that's lifting inflation. And inflation never really got back down to target. And so central banks have lost patience and are having to hike interest rates. They're also able to do that because the employment market around the world is stabilizing. So, we had seen a normalization in employment markets, less demand for labor. That's actually started to normalize a bit. And so central banks are largely comfortable that we've not got a labor market recession, and inflation is too high, therefore they're going to have to hike rates. We saw that in New Zealand last week.
Yeah. On that, now that the RBNZ is in a hiking cycle, certainly done with cutting, does that mean that our currency should appreciate as well?
Yeah, we've seen the Kiwi dollar being pretty weak, really, and that's because we had low interest rates here, and our economic growth was pretty mediocre, and so people were happy to sell the Kiwi dollar and own other currencies, including the Aussie dollar, where you were earning more interest from holding that currency. The change last week did change the fortunes for the Kiwi dollar, and we think that might persist for a little bit longer. So yeah, we're more constructive on the Kiwi dollar against the Aussie, and to a lesser extent against the US dollar, which has been quite strong this year.
What about the big risks over the next 6 months? We have midterm elections in the US, and I was thinking about this morning, knowing I was going to talk to you. Would markets be more worried if Trump gets more power out of the midterms, and does more stuff, or has some power taken away and goes crazy? How do markets view such a? It's obviously not a presidential election, but it's a pivotal one in terms of power, right?
Yeah, that's right. And we've seen over the last 18 months or so of this new Trump presidency, his willingness to try and dictate what markets are doing, right? The tariff episode came, and he was willing to send equities lower, only then to come out and say equities are a great value, go and buy them, and all of a sudden, woof, we're off to the races again. He did it again this year with the attacks on Iran, right? This is a kind of a market that's talked up and down by this US administration in a kind of greater way than we've ever seen before. And so what happens at the midterms, I think, will be consequential, but we just don't know yet. We're a little bit far out. It looks like the Republicans are going to take a beating. But given that much of the policies that Trump's been doing has been just from the presidential office rather than involving Congress or the Senate, actually, you could probably still expect a lot of those to continue, irrespective of whether they take a beating or not. And so I think it's going to be interesting, and there's going to be a lot of focus from the market on it, but it's too soon yet to call which way it's going to go.
Yeah. No, you're right. The tariffs, a short war, I mean, these are things the president can do, right?
Yeah.
Well, until the courts say you can't. What about other risks to the economy, heading into the second half of the year? What else are you keeping your eye on?
Yeah, so the global economy is largely running reasonably well, and it's not something we're concerned about. We're not concerned about a global recession anytime soon. Look, we're kind of in and around kind of trend growth, if you like, in most regions. If central banks have to hike much more, then maybe that will weigh on that a little bit. But I don't think anyone's expecting, or including ourselves, material economic weakness going forward. It's really about this AI boom and kind of whether that can continue bubbling away. And bubbling, I think, is the right word. There are elements of of this which is kind of rhymes with what we saw during the dot-com boom. So that can continue for a while, but of course it creates risks on the other side. And arguably, the volatility we're seeing in some of the pockets of the market now are akin to what we saw, in 98, 99. Back in the dot-com boom. So that's what we're watching very closely. Technology as a sector is now such a large component of global share markets that it is, by definition, the biggest risk and the biggest thing that we've got to focus on.
Excellent stuff. Now, don't make it 6 months before I see you again, Mark. Thank you very much for being with me.
Thanks very much.
That was Mark Riggall, Portfolio Manager at Milford, talking to us about the 6 months ahead. Don't forget, you can like, follow, subscribe this podcast wherever you like to listen. Until next week, don't forget to invest in yourselves.